Today, Tom Lee is set to reveal some major insights for XRP holders and anyone involved in the crypto world. He's diving deep into the current financial landscape and examining how these trends might impact our crypto investments. So it's worth paying close attention to what he has to share. According to Tom, the market has been fixated on the potential downsides, fears of a recession or a trade war with China causing major economic damage. This focus on the negative side is why many investors remain cautious. But there's another side to this story. The US has significant opportunities ahead, like increased exports, less regulation, and new tax policies that could encourage investment. These factors don't just boost price-to-earnings ratios, they could also grow actual earnings. Tom's point is that you don't need to predict the exact outcome. With around $7 trillion sitting idle in cash, and overall investment mood still gloomy, the market just needs to be wrong for things to turn around. What Tom Lee says really hits home for me, because it carries an important message. When headlines are full of fear, that's often the best moment to step in. From my experience, I've made some of my biggest gains buying cryptocurrencies on the days when prices plunged the most, and I've taken profits on days when the market surged. I follow a simple rule. If a top 10 crypto drops more than 10% in a day, I buy heavily, no questions asked. On the flip side, if it jumps 15% or even 20% during a bull run, I usually lock in some profits, especially when trading futures. Personally, I believe holding on to XRP and HBR long term is the smarter move. Tom Lee covers a lot more in this video that I think will be really valuable to you as well, so let's dive in and break down everything he has to say. Let's dive into this, and afterward I'll share some key insights you'll definitely want to keep in mind. Pay close attention. To kick things off, it's important to realize that there's usually some part of the US economy in recession at any given time. Over the past 5 years, I'd say about 20% of the economy has experienced recession-like conditions. That's why experts talk about a rolling recession. The ongoing trade war seems to be causing even more of these localized downturns, but that doesn't necessarily mean the entire economy is shrinking, because GDP can still grow slowly, even if certain sectors are struggling. Take housing, for example. It's been in a recession for 3 years now. Historically, whenever housing dipped into recession, the whole economy followed suit. But this time, despite the housing slump, the broader US economy has been holding steady. So the big question we're all trying to answer is, if the trade war slows down trade enough to cause a trade recession, will that pull the entire economy into a full-blown recession? We know trade is slowing, but it's unclear if that alone is enough to tip the whole system. One thing I'm watching closely is the high-yield bond market. When the difference between high-yield interest rates and safer risk-free rates, known as the spread, hits 1,000 basis points, that almost always signals a recession is on the horizon. Right now, though, it's sitting at 367 basis points. To me, that suggests we're dealing with more rolling recessions rather than a full-scale US recession. This is why I asked for clarification, because it's tempting to say GM is in a recession, so the economy must be too. But even if GM faced a deep slump, it probably wouldn't drag down the whole country. Of course, if too many sectors start to fall into recession, then it could drag the overall economy down as well. You're basically wondering, if rolling recessions are happening, why don't they all combine into one big recession? The answer is yes, that can happen, but historically it takes a major shock. For example, a massive spike in oil prices, imagine it jumping to $300 a barrel, would make oil spending about 15% of all US expenses. That kind of jump would be a real shock, considering oil is currently around $50. In the past, such a price surge has triggered recessions. Another way a recession can hit is through a financial crisis, like what happened in 2008. If banks or credit markets collapse, it pulls the entire economy down with it. But if only manufacturing or housing faces recession, it usually isn't enough to create widespread economic fallout. Remember back in 2023, when regional banks ran into trouble, many feared a depression because those banks were seen as a critical firewall. If they failed, the worry was that credit would freeze everywhere. We did experience a crisis with regional banks, yet the economy stayed stable. However, in 2022, the economy faced a string of these rolling recessions that have been ongoing for 3 years now. That year, the S&P 500 dropped by 27%, and corporate earnings didn't bounce back until the latter half of 2023. Back then, many investors were convinced the market would slide even further, believing that these rolling recessions combined with the Federal Reserve's tightening would trigger a deeper downturn. But we pushed back hard against that idea, pointing out that consumer debt levels were still low enough to prevent a major recession. Those same conditions still apply today. Both businesses and consumers aren't overly burdened by debt. Yes, job losses could happen, and that's why a recession is possible. But anyone who's absolutely certain a recession is coming is likely mistaken. This is exactly the message you're hearing from many economists right now. In my 30 years of experience, I've rarely seen economists accurately predict recessions, so the fact that so many are calling for one might actually mean the chances are pretty slim. Usually by the time economists admit we're in a recession, it's already underway. That was the case back in 2008. Tom Lee offers a refreshingly unique take on recessions, and his concept of rolling recessions is super important for everyone to grasp when it comes to understanding economic cycles today. Unlike decades ago when economies like the US depended heavily on one industry, oil for example, modern developed nations have much more diversified economies. We're now fueled by software, virtual services, artificial intelligence, cryptocurrencies, and a host of multinational corporations that aren't tied down to any single sector or trade. While a massive supply shock like oil hitting $300 a barrel is still possible, it's becoming less likely because economies are broadening the types of businesses they engage in. Plus, much of today's commerce, such as software, can't be slapped with tariffs since it's not a physical good. Tariffs definitely hit physical products, the things we use daily, but there's a whole lot more going on beyond that. Like Tom Lee pointed out, some industries experience recessions while others keep moving forward, and that doesn't automatically mean the entire US economy will follow suit. For instance, in 2020 and 2021, steel and manufacturing faced a serious downturn. Many jobs tied to those trades were impacted, but the overall economy kept charging ahead, and Tom Lee believes that momentum isn't slowing down anytime soon. To add to his credibility, Tom was one of the few calling for higher Bitcoin prices when it was still trading under $80,000, even when many thought the bull run had ended. I was also buying XRP heavily when it was under $2, thinking it was a smart move, and here we are now. That said, short-term swings and wild price swings are still going to happen in crypto markets. But if XRP drops sharply in a short span, I'm personally ready to buy more. There's plenty to consider from all this about how the economy actually works. I'm really interested to hear what you all think about Tom Lee's take on rolling recessions and how the global economy is evolving and diversifying. Drop your thoughts below, I'm eager to know your perspective. And while you're at it, don't forget to join Crypto Crusaders if you haven't already. I want to highlight that in just the past couple of months we've seen some incredible gains, over 267% growth in only 2 months. It's pretty wild what we've been able to achieve in this group. I share my trades there so you can either copy them, use them as a reference, or just watch how things move.